Hey guys, welcome back to our channel. Thank you for joining us today. Today we will be speaking about how companies like Amazon, Nike and FedEx avoid US taxes. Please watch the entire video to figure out all the details. And guys, don't forget to like, share, subscribe and click the bell notification. Alright then, let's get started. The ongoing United States tax code permits probably the greatest organization names in the country to not pay any federal corporate income tax. It isn't uncommon for enormous U.S. corporations to pay no U.S. income taxes despite creating billions of dollars in gains. 55 of America's biggest organizations paid no income taxes over the 3-year time frame from 2018 to 2020, all while creating powerful profits. Many even gotten tax refunds amounting to countless dollars. How do profitable corporations pull off making good on no taxes? The most common ways are speeding up depreciation, offshoring benefits, investment opportunities, and tax credits. Preceding the Tax Cuts and Jobs Act, TCJA of 2017, the top corporate tax rate in the U.S. was one of the world's most noteworthy at 35%. Toward the beginning of 2018, the corporate tax rate was 21%. The basic number is the consolidated top corporate tax rate, which incorporates state and federal taxes, decreased by any federal deductions for state taxes paid. In the U.S. in 2021, that consolidated normal top corporate rate is 25.8%, underneath the normal for nations remembered for the Organization for Economic Cooperation and Development Nations. It likewise is lower than in a proportion of its friend nations. The practically identical rate in France is 32%, even though it will be diminished to 25.8% in 2022. Portugal is most noteworthy at 31.5%. No less than 55 of the biggest corporations in America paid no federal corporate income taxes on their 2020 benefits, as indicated by the Institute on Taxation and Economic Policy. The organizations incorporate names like Whirlpool, FedEx, Nike, HP, and Salesforce. On the off chance that a huge, entirely profitable organization isn't paying the federal income tax, we have a genuine decency issue on our hands. Matthew Gardner, a senior individual at the Institute on Taxation and Economic Policy, ITEP, told CNBC. Likewise, it is legitimate and inside the boundaries of the tax code that corporations can wind up reimbursing no federal corporate income tax, which costs the U.S. government billions of dollars in lost income. There is a container of corporate tax breaks that are purposely in the tax code and large. They cost the federal government generally $180 billion every year. And for comparison, the corporate tax achieves $370 billion of income a year. Chai-Ching Huang, chief head of the NYU Tax Law Center, told CNBC, referring to Explore from the Tax Foundation. CNBC contacted FedEx, Nike, Salesforce and HP for input. They either declined to give a statement or didn't respond before publication. The 55 corporations referred to by ITEP would have paid an aggregate out of $8.5 billion. All things being equal, they got $3.5 billion in tax discounts, emptying $12 billion of the U.S. government as per the Institute. The figures do exclude corporations that paid only some, yet not these taxes. I think the principal issue here is that corporations book the benefit are two distinct manners. Garrett Watson, senior policy investigator at the Tax Foundation, told CNBC how many benefits that corporations might be detailing for monetary purposes might differ from the benefits they are revealing for tax purposes. Some tax consumptions, which come in a wide range of structures, are utilized by certain organizations to exploit decisions that empower them to bring down their successful tax rates. For instance, Gardner's investigation into Amazon's taxes from 2018 to 2021 showed an announced $79 billion of pre-tax U.S. income. Amazon paid an aggregate $4 billion in federal corporate income tax in those 4 years, compared to a compelling yearly tax base of 5.1%. Gardner's ITEP report indicated that about a fourth of the federal corporate tax base is 21%. Amazon told CNBC, in 2021, we detailed $2.3 billion in federal income tax cost, $5.2 billion in other federal taxes, and more than $4 billion in state and neighborhood taxes, everything being equal. We likewise gathered an additional $22 billion in deals taxes for U.S. states and territories. One controversial type of federal tax use is the offshoring of benefits. The foreign corporate income tax, somewhere in the range of 0 to 10.5%, can boost the moving of benefits to tax-safe houses. For instance, Whirlpool, a U.S. organization known for assembling home apparatuses in the U.S. and Mexico, was referred to in a new case, including U.S. and Mexican taxes. Whirlpool did that by having the Mexican operation claimed by a Mexican organization without any workers, and then having that Mexican organization possessed by a Luxembourg holding organization with one representative, Huang told CNBC. And then, at that point, it attempted to guarantee that because of the combination of the U.S., Mexico, and Luxembourg tax rules, it was attempting to exploit the disconnect between those tax frameworks to stay away from tax. And those nations and of the court said, no, that goes excessively far. Whirlpool safeguarded its actions in a statement to CNBC. The case before the Sixth Circuit has never been tied in with attempting to keep away from U.S. taxes on the benefits procured in Mexico. This tax question has forever been about when those benefits are taxed in the U.S. Truth be told, years under the watchful eye of the first tax court decision in 2020, Whirlpool had previously paid U.S. tax on 100% of the benefits acquired in Mexico. The IRS figured Whirlpool ought to have paid those U.S. taxes prior. Corporations have become very smart at tracking down ways of covering less in taxes. Here are the large 4 tax aversion procedures. Number 1. Accelerated depreciation. It is one of the main business breaks in the U.S. tax code. Accelerated depreciation permits an organization to deduct the expenses of resources they gain over a time of years and at a rate that surpasses the real depreciation of the resources. It is the greatest single corporate tax break in the U.S. tax code. Whenever organizations procure costly resources similar to structures or production line hardware, they can then deduct their expenses from their benefits for years. It is one of the tax breaks that got better with the TCJA. The new regulation made full discounting legitimate. Corporations can discount the whole expense of interest in the year it is made. 2. Offshoring profits. There are huge tax-motivating forces for American corporations to move benefits and occupations abroad. Many organizations have tracked down approaches to incorporate beyond the U.S. formally and pay smaller corporate tax rates in their new home nations. Even though a critical portion of their operations might, in any case, dwell inside the U.S., they partake in a 0% tax rate on most benefits produced seaward. Holding cash in seaward tax sanctuaries is another common methodology. Localizing it to the U.S. would mean paying taxes on it. Large tech alone, driven by Apple and Microsoft, uncovered a sum of more than $100 billion in their latest monetary years made abroad and held seaward, and in this manner it was not exposed to U.S. taxation. Bloomberg News noticed that product code is simpler to move around than manufacturing plant equipment. Other corporate tax breaks benefit different ventures. Specific banking and protection income are liberated from taxes, assuming they are procured abroad. Passable benefits and depreciation costs can likewise pose a potential threat. Interest from obligation is additionally deductible. In its most essential structure, Supporting costs to balance incomes will decrease the tax rates that corporations pay. 3. Investment opportunities. Investment opportunities have turned into a standard type of compensation for organization CEOs and other top leaders. Representatives love them since they can be incredibly worthwhile. The organization grants them the option to purchase a set number of offers at a particular cost soon, commonly in 10 years or less. On the off chance that the organization's stock ascends, they cash in. Organizations love them since it permits them to report bigger benefits to their investors while detailing more modest benefits to the Internal Revenue Service. That permits them to all in all save billions on their taxes. Number 4. Corporate tax credits are expected to motivate organizations to participate in exercises or practices that the public authority believes are gainful to the nation. The rundown of conceivable tax credits is long, from one for giving childcare to representatives to one for utilizing biofuels. Some are industry explicit, for example, the mine salvage group preparing credit. The bottom line is legitimate. The large tax rates paid by corporations could be fairly higher. While figuring in the huge number of rates these elements should pay on an overall premise. In the U.S., their installments come in far underneath the stated corporate rate. Yet these organizations should, in any case, pay taxes to the abroad locations they carry on with work in or find their base camp to. Generally speaking, it raises doubt about the need to diminish the authority corporate tax rate since it has little relation to the rates that American corporations really pay. Well, that's all we have today. If you've enjoyed today's video, don't forget to like, share, and subscribe.